Thank you very much, Jackie, and welcome to all our clients and colleagues who are joining us for today's webinar, which is based upon the findings of our global office space forecast. Joining me today for the presentation are Ken McCarthy, our Chief Economist, and Rick Cleveland, our Research Director for Corporate Investor and Occupier Services. During the Q&A portion of the webinar, we will also have available Marcelo da Costa Santos, Vice President of Capital Markets and Valuation and Advisory in South America, Stuart Barron, Head of Research for Canada, and Paula Munger, our Mid-Atlantic Research Director and the primary author of the report. Ken is going to start us off with a global economic overview. I'm going to follow Ken with a global office outlook and then a bit more focus on the Americas. And then Rick will provide us with some insight on trends in workplace strategies. And then we're going to open it up for Q&A. So now it's my pleasure to turn it over to Ken McCarthy.
Thank you very much, Maria. As we end 2013, the global economy is clearly in much better shape than it was at the beginning of the year. You may recall a year ago at this time we were facing a fiscal cliff in the U.S., which had not been resolved. The Eurozone and much of Europe was in recession, and we were experiencing slowdowns in growth in China and much of the Asia-Pacific region. So we entered 2013 with a lot of uncertainty. We are exiting it in much better shape. In the U.S., in Europe, we ended the recession in mid-year, and we're now seeing growth in GDP through the Eurozone. We're seeing particularly strong performance in the British economy, the UK economy, and as you will note from our report, some of the strongest expected growth in the European markets are going to be in Dublin and London. In the U.S., the brinkmanship surrounding the budget does continue to some extent, but it's pretty much over. After the temporary or partial government shutdown in October, we are now facing one more deadline to pass a budget and deal with the debt ceiling. We expect that will probably pass without any significant drama. There will always be some drama, but not that much. And that after that, as the uncertainty about government policy is reduced, the private sector, which has been increasingly healthy, will exert stronger growth. In particular, the housing sector is expected to show significant growth, and that will feed through to the consumer economy, lead to stronger improving confidence, and that will lead to, we think, stronger business investment and stronger hiring, and we'll enter a much more self-sustaining recovery. From this year, GDP growth in the U.S. of about 2%, maybe a little less than that, 1.8%. Next year, we're looking for 3%, more or less, and accelerating even further in 2015. In the Asia-Pacific region, China, the dominant economy, has accelerated as the year progressed and is set up for stronger growth, growth more on the order of 7 to 8% in GDP as opposed to the 6 to 7% we saw through much of this year. In addition, the Japanese economy is picking up as the impact of the policies implemented by Prime Minister Abe are felt. And so we think the Asia-Pacific economies, instead of growing, 5% in 2015, will grow more like 6 to 7%. And we'll see stronger growth, particularly in exports. If we go to the next slide, I've got a series of maps here which basically show where the growth is globally today and in the coming years. And so we're color coding. The strong growth, which is the red color here, is in places like China and much of Africa. And most of the world is green, blue, or dark blue, which is sort of sluggish growth. If we could turn to the next slide, we take a look at 2014. All of a sudden, there's a lot more green, and we start to see a lot of the sort of brownish orange color. So we're seeing growth in more countries of over 3%. In the Americas, healthier growth is expected. In much of Europe, which had been in recession last year, we're going to see, we think, growth in 2014. Modest growth, but growth nonetheless. and in the Asia-Pacific region, we're seeing much stronger growth next year, we think, than we will as we close out 2013. And then on the final chart, we get even redder and oranger as we start to see growth accelerate in 2015. So we're in a period of transition to stronger growth. We think the growth will accelerate in 2014 and get even stronger in 2015. In the Americas, you can clearly see that in the expectation of faster growth in the U.S. that will flow over into Mexico and Canada. And in Brazil, we expect to see stronger growth in the next couple of years as we have the World Cup there next year and the infrastructure spending that will lead up to the Olympics in 2016. So if we go to the next chart, I've just got two more charts. I want to take a look at where the growth is and where the opportunity is. You saw the map. Now this is the projected average annual growth rate for 2012 to 2015 for the major economies of the world. And you can see clearly the growth in terms of aggregate GDP growth is largely concentrated in Asia. That's where the big numbers are. 4%, 5%, 7%, those kinds of numbers are in places like Indonesia, China, India, Malaysia. And the weaker growth is in Europe, but that's really no surprise. 2013, as we said, was a weak year. In Europe, they just came out of a recession. And in the middle, we've got this sort of 2.5% growth, which is the U.S. and many other the Americas region countries. If we turn to the next page, this is also, I think, gives a sense of opportunity where there is a change in growth. What we're looking at here is the projected GDP growth in 2014, and we're subtracting the expected growth in 2013. So this is the change in the growth rate. And here, and obviously the faster, the larger the change, the greater the opportunity is within that country. And here, what emerges is that a lot of the improvement over the coming year will be in Europe. With a lesser, and in Mexico is in there too, but to a lesser extent, the Asian countries, which are already strong. So where's the opportunity? Where is the growth going to emerge more strongly? Mostly in Europe and to a lesser extent, the Americas and Asia. Overall, as I said, 2014 we expect to be a much better year for the global economy. Much will depend on the U.S. emerging and starting to enter a self-sustained recovery, and as that occurs, demand for imports, particularly from Asia, will begin to pick up as well as from regional countries, Mexico, Canada, and Brazil. So we're looking at a much better picture in terms of the global environment for 2014. And I will now turn it over to Maria, who will take a look at how that impacts global office markets and America's office markets.
Thank you very much, Ken. So first, as I mentioned, I'll take a look at the global office market. And in the study itself, in the forecast report, we covered about 66 markets. So you'll see in the Americas section of this, we'll focus in on some of those markets in the Americas. And when we show you the rankings, bear in mind that we covered 66 markets in all. Globally, the U.S. right now is in a very strong position in the Americas in terms of balanced market fundamentals of supply and demand. The two sectors that continue to be the strongest and are really driving us out of the real estate doldrums are technology and energy. And even with supply returning to some markets like New York, San Francisco, and Boston, the demand in these markets will be steady, and our expectation is that rents for prime space will continue to increase over the forecast horizon. By contrast, in Canada, Mexico, and Brazil, we have seen and will continue to see large amounts of supply hit the market. In Canada and Mexico, we're seeing weak demand, and so we'll see favorable conditions for tenants in these markets during the forecast horizon. Rents should remain flat throughout the period, but we will see some recovery, as Ken mentioned, in 2015. Brazil is right now in the midst of a market correction. So coming off very high rents and strong demand with a slowdown in GDP and growing population, we see a tremendous amount of construction coming online both in Rio and Sao Paulo. And so while the markets may give the appearance of rent increases because of this new supply, when we look at rental growth over a longer-term horizon, we really don't expect strong rental growth in Brazil until 2016. If we move on and look at Europe and Asia, Phil. In Europe, the recovery, Ken mentioned, will be strong, but it will be a bit slower in terms of real estate following suit. Real estate always following the economic recovery. So we'll see a gradual increase in labor and therefore a gradual increase in the demand for space. The other phenomena that Rick will talk about more specifically, and we do have a section of our report devoted to it, is workplace strategy and the move toward efficiency and space utilization. So the aging space, as well as a lack of supply in Europe in many markets, especially in the emerging markets, will result in upward pressure on rents, on prime rents in particular. That is also going to be true in core markets, some of them we've mentioned already, like London, Stockholm, Dublin, where we'll see some rental increases because of the absence of supply. In Asia, we will also see, and continue to see, as we have in our last two reports, a significant amount of development in the pipeline. Demand there, however, has also weakened. So we will not see significant rental growth during the forecast period. There are some exceptions to that, as you'll see when I show you the rankings shortly in markets like Tokyo and Manila. So if we move on and start to look at the data from the report, and we look at the rankings, we have three of these charts. First, we're going to show supply, and supply as a percentage of inventory. So 8 out of these 10 markets, having ranked the markets, these are the top 10 in terms of new supply as a percentage of stock, are in the APAC region, the Asia-Pacific region. The two markets that are not are Istanbul in Turkey, which is experiencing a surge of demand, and then also Sao Paulo. Going to the next chart, where we take a look at rental growth, absorption as a percentage of inventory. First absorption, and then we'll show the impact on rents. This is where we're seeing significant increase in demand. So in effect, in many of these markets, at least what we anticipate will happen during the forecast horizon is that the demand for space will keep up to a certain extent with the supply. And there are, again, 8 out of the 10 markets that are in the Asia-Pacific region. I did mention that Sao Paulo is undergoing a market correction, and so what we're going to see here in terms of rents, and you'll see that in just a moment, is that while absorption as a percent of the inventory is fairly strong, the supply is really too much in a sense, and we don't have enough demand to accommodate that growing supply in the short term in some of these markets. So now let's take a look at the rental growth. And here what we're looking at is rental growth over the 3-year period, really, the full year 2013, all of 14, and all of 15. We think that this is a very good measure that shows what really is happening in these markets in terms of conditions. When we look at rents over a 1-year period or a shorter time horizon, we can see spikes that may be the result of a few large transactions or new space coming to the market. But the data gets smoothed out when we look at them over a longer time horizon. So we think that this chart really reflects where we will see the strongest growing rents and the strongest growing markets in terms of rental growth over the forecast period. It's an interesting mix in the sense that it is a lot more diversified than we have seen in the last 2 forecast periods. So we have 5 new markets that are on this chart if you were to compare it to our report last year. A few of them are in the U.S., Boston, San Francisco, and New York. And as I mentioned earlier, we have Tokyo and Manila that are also joining this mix. Finally, looking at the global markets in terms of position in the cycle, first we'll take a look at where we are now, 2013, and then how we see this changing in 2015. And these are presented as broad regions. When we take a look at the Americas, we'll really carve out some of the markets a bit more specifically. As a result of the supply situation, you can see the growth markets in Asia Pacific and in Latin America. And this is really more reflective of Brazil, to be clear, than it is of some of the other markets in Latin America, are either in a slow growth or a downturn situation. And really what this chart reflects is whether or not we are experiencing tenant favorable or landlord favorable conditions. And what we have in the recovering markets, and we have many of the markets or regions really sitting right now still emerging and recovering in terms of rental growth. And Western Europe are over that equilibrium line in the accelerating mode. If we move, and the same, by the way, can be said of North America in terms of this is a broad regional view, and we'll take a look more specifically at how Canada, U.S., and Latin America fare in the Americas portion of the presentation. If we look at 2015 from a global perspective, you'll see some differences. And as my colleague David Hutchings likes to say when he looks at this chart, it's getting very crowded in the accelerating quadrant of this chart, and it will get very crowded by the end of the forecast horizon in 2015. Still in slow growth and in downturn are those markets which will need to absorb supply. I think it's important to note in this chart that you can go in either direction in terms of the market cycle, so you can jump, if you will, from slow growth to accelerating depending upon the market conditions, or you can actually decline. And that really is a result of a number of different variables taking place, both in the real estate market and the economy, as well as the overall operating environment, including things like elections and legislation. And we have a number of those things taking place in places like India and Mexico, for example. So now we'll shift gears and go from our global overview into the Americas market overview. We'll look first at the U.S. and then Latin America and then Canada. Just a little bit more detail on the markets in terms of the supply sector or the supply situation. Boston, San Francisco, and Manhattan have a fair amount of construction in the pipeline right now. In Manhattan, we have 10 million square feet under construction. However, 48% of that is pre-leased. So we think the result of this and the impact on prime space is that we will continue to see absorption, and we'll see stronger absorption through the forecast horizon, which will cause upward pressure on rents. In Latin America, again, the scenario really calls for increased construction in Santiago, although Santiago is a smaller market and has very strong demand and is the superstar right now in that portion of the region. However, the supply side in Brazil will cause that market to continue to go through this corrective period until the end of the forecast horizon. Mexico City, we think, has some opportunity there. If you look back at the data that Ken provided, you'll see that the economy is growing, there is supply, and it will go through a blip in a short-term situation. But the appetite for Class A space there is strong, and we think it will improve by the end of the period, although right now we are seeing rents remain fairly stable throughout. Looking at Canada, we have about 5 million feet that will, in each of Toronto and Calgary markets, they will not all deliver in the next 2 years, but it is a significant amount of supply in the face of softening demand. We expect slow improvement. We'll see that in the cycle chart in just a moment. And rents may decline, although modestly, in the beginning of the outlook horizon, but they will respond and start to grow by the end of 2015. So for the balance of the region, Mexico, all of Latin America, and Canada, we see 2015 being a growth where we'll see the significant growth. Okay, Phil, let me show you a little bit more specifically where that supply is actually taking place, so you can really see it in the numbers here. And this is a chart that ranks supply for the region as a percent of inventory. And I don't think you have to go down the chart too far to see the markets and the regions that I mentioned and where we have a lot of the building that's going to take place. And you see some of the markets in Canada are interspersed with some of the markets in Latin America. And those U.S. markets do have some supply, as I mentioned. But interestingly enough, as you go down this graph, you will see We have some markets that have absolutely no construction in the pipeline over the next 2 years. What's going to be the impact of all of this? How do we see absorption taking place, and what's the impact on rent for these markets in the Americas? If we look at slide 21. So this chart, this scatter graph can be a bit confusing, so let me see if I can point out some of the highlights to you. If you look above the red horizontal, or actual the diagonal line, which is the average across all the markets, those markets that are above the line really are where we expect to see the most significant rental growth in the region. We've talked about a number of them so far. You see the tech markets, the energy markets, and so on. Below the line, we're actually and this is over a 3-year time horizon, annual rental growth. We expect that in some markets we'll see some declines, as I mentioned, some modest declines in some Canadian markets, and then also in Rio de Janeiro, where absorption has been weak this year, and in the face of new supply and modest demand, we think we'll actually see some softening of the rents there. The other thing to point out here is where you see this strong rental growth, those are going to be markets where we're going to see a strong landlord shift, and then the others will remain favorable for tenants. We see that evidence in the cycle graph on page 22 or slide 22. 2013 in some ways has been a year of a bit of a lull, if you will, in some markets. That's why we see some markets kind of sitting and hovering in that slow growth and downturn situation. A few that have made their way into the accelerating quadrant where we see stronger demand and thus stronger rental growth, and some that are sitting in the recovery position. If we look at 2015 by comparison, we still see a number of markets sitting in the slow growth quadrant. Again, a number of the Canadian markets are there. Some of the U.S. markets are accelerating, and we do see some movement in South America into a position of recovering. And that leads us to believe that by 2016, we are very likely to have a lot more markets in the Americas entering into that accelerating phase, where we will begin to see a much stronger shift from tenant favorable to landlord favorable. And now I'll turn it over to Rick Cleveland, who will talk about trends in workplace strategies. Rick?
Thank you, Maria. As you said, I'm going to talk about, in the next few minutes, I'm going to discuss some of the underlying trends that are driving the space market fundamentals that Maria presented, and some of the challenges that both occupiers and investors are dealing with. So with that, we'll go to the first slide. From the occupier perspective, really the predominant issue facing corporations today, as Maria touched on, is what to do with the workplace in this concept of workplace transformation, which really means how should they, or how are they changing the work environment to optimize productivity, efficiency, and cost. C&W recently conducted a global survey of occupiers on the topic of workplace transformation and workplace change to see what was driving some of their decisions to take on these types of initiatives and change programs. And this chart here notes the top 5 responses, or the top 5 factors really that are driving occupiers to take on workplace change initiatives or workplace transformation. And as you can see, reducing real estate costs ranked as the highest factor for companies in terms of taking on workplace strategy initiatives. It's not a big surprise. Corporations today are still under a tremendous amount of pressure to contain costs. Real estate is obviously a significant portion of a company's overall cost, and corporate real estate executives, around the world are still facing significant cost pressures from what we call the C-suite or their executives to really control and contain the overall cost of their real estate portfolio. So that is obviously a big factor in any workplace strategy or workplace transformation initiative. The second one is actually a very significant factor, and not one to be ignored, and that is attracting and retaining employees. This is a very significant issue for global occupiers, and I'll get into a little bit more some of the solutions that they've come up with for doing this that are affecting the space markets and affecting decisions about location. But attracting and retaining employees through the corporate real estate and through the workplace is a significant issue for occupiers. And then the last three kind of really go hand in hand with each other. Obviously, they want the workplace to be as efficient and as productive as possible. And we've all heard a lot about increasing communication and collaboration and creativity. So these five factors above, I think anything else, continue to be top of mind for companies as they think about their work environment and as they make decisions about their space going forward. The next slide. So the same survey, we realized that the pace of this type of change is fairly robust. This slide depicts depicts the responses to the question, what stage are you in, or what stage are global occupiers in with their workplace transformation programs? And as you can see, the responses that are in anything in blue, with dark blue, medium blue, and light blue, indicate either that the occupier or the respondent has, and the respondent's organization has either completed their workplace strategy programs, they're in the process of implementing it, or they're currently planning one. So, a majority of corporations globally are in the process of implementing these programs, and that's driving a lot of the change that you're obviously seeing in the marketplace. Next slide, please. So this workplace change and workplace transformation is not occurring without changes to square feet usage and utilization. Space density is on the rise, and higher density is really the most direct way for companies to lower their real estate costs, and they're using a variety of strategies to get the square feet per person lower. So in 2010, you'll see here by this chart or this graphic here, you'll note that the average square feet per person globally was 225 square feet. Well, in our survey of corporate real estate executives, a majority expect that by the end of this year, so really now, that a majority of corporations will be at or around the 150 square foot number per employee. And then also more significantly, in 5 years, over half of the respondents indicated that they expect global corporations will be at or around 100 square feet per person. So this obviously has significant implications for square feet of demand. Corporations are getting to these numbers through a variety of methods, some of them being hoteling, work from home and mobility strategies, and so on and so forth. And the increase in collaborative and common area space will offset some of this theoretically, but the overall trend here is that while as the corporate economy begins to recover, you may see less on average demand for more real estate. So again, something that we need to take into account as we think about where demand will be over the next couple of years. So the next slide, please. So, when we talk about space optimization, workplace strategy, increasing collaborative areas, hoteling, mobility programs, and things like that, the question becomes this, what does it mean? An obvious question becomes, what does it mean for owners? And for starters, we're starting to see many owners really wonder how and if their buildings can support the demand, the increased requirements in this type of new sort of way of working. So, Maria touched on this in some of her comments about the global work environment, but we have an aging inventory in a lot of our major CBDs, and as we recover and as demand does pick up, I don't think it's something that that owners can ignore, because the demand requirements aren't changing. They're embedded. Companies are focused on improving and in changing and transforming their work environments. And today's owners and today's buildings need to be able to respond in order to be competitive. So this slide here notes it takes the Class A office market just in the United States, the core U.S. investment markets, and it breaks it out by a year of construction, or decade of construction rather. And as you can see, the majority of buildings in the major investment markets were constructed prior to 1990, and a good chunk of them prior to 1980, or were built in 1980 or earlier. So the question for owners becomes: Can yesterday's buildings really support tomorrow's workplace? And particularly as it relates to density. And so, there's some significant risk here, and this will be a significant challenge for owners going forward. Getting a lot of these older inventory up to snuff in terms of their infrastructures. It has a significant impact on elevators, lobbies, mechanical and engineering, plumbing, retail, so on and so forth. And owners are wondering how and where to invest the capital, and how do they keep their buildings competitive. So that's obviously a significant issue going forward as well. The next slide, please. And lastly, one of the most significant trends we're seeing right now, in reaction to a lot of this, both in reaction to the aging inventory, as well as in a reaction to the occupier requirements and demand, is this emergence of new submarkets really within our core cities. You're seeing, around the major cities here in the U.S., at least, new submarkets pop up that offer a variety of different types of amenities and different types of buildings to accommodate the occupier demand. And we're seeing investors and owners responding by going into these submarkets and constructing buildings. Many of the core CBDs are experiencing this trend. For example, Midtown South in New York, Boston Seaport District, the South of Market submarket in San Francisco. These submarkets are offering a 24/7 type live, work, play environment, and companies are using them to attract and retain their employees. So you're seeing in many cases companies moving from suburban locations, paying more to be in these sort of revitalized urban locations that offer these amenities, because they're able to recruit the talent that they need to keep their businesses going. They're willing to pay more in their real estate costs to pay less in their human resource costs, and that's a trade-off that we're seeing companies willing to make time in and time again across a number of different markets. So, that in of itself, I think, is a trend that we'll see continue and develop more, and one that we're paying close attention to, in 2014 and beyond.
We'd like to thank you for joining us today, and we invite you to visit our website, CushmanWakefield.com, where you will find our forecast report, recordings of this webinar and similar webinars that have been held in Europe and will be held in Asia, and additional thought leadership.